Welcome to Manifested Publishers. My name is Mr. Dongo, Public Finance and Taxation Lecturer. Today we are going to handle public finance paper that is August 2024, question 4. August 2024, question 4. August 2024, question 4. August 2024, question 4. So the first question, that is question A, explain the following terms as used in taxation. Explain the following terms as used in taxation. One is what you call duty drawback. Question 4A, Roman 1, is what you call duty drawback. What you call the duty drawback. So when you talk about duty drawback, we're saying means a refund. This basically means, we say means a refund of all or part, or we say or part, refund of all or part of any import, duty paid in respect, we say in respect of goods, exported, in respect of goods exported, or used, we say used in a manner, or for the purpose, exported or used in a manner, or for purpose, prescribed, we say prescribed, purpose prescribed as a condition, we say as a condition, for granting duty drawback, So very important we say that when you talk about duty drawback, we basically mean a refund of all or part of duty or part of any duty of any import duty paid in respect of goods exported or used in a manner or for the purpose prescribed as condition for granting duty drawback. So the key word is refund of all or part of any import duty paid in respect to goods exported. So that is what you call a drawback. The second, that is A Roman 2, we have what you call sufferance, WAF. So when you talk about sufferance work, it basically means any place, we say means any place, other than, any place other than, unapproved, what you call unapproved, any place other than approved place of loading, we say loading, or offloading, loading or unloading, or offloading or unloading, any other than approved. So it means a place other than approved, a place other than the approved. Approved basically means the one that is recognized for loading and unloading, at which a commissioner may allow, any good to any goods to be loaded, or unloaded. To be loaded or unloaded. To basically be loaded or unloaded. So then we have Roman 3. We have Roman 3, what we call import declaration fee. Import declaration fee. So when you talk about import declaration fee, this is basically paid to goods that are imported into the country, basically for home use. Goods that are imported into the country, basically for home use. So we can put it down and say that it is a fee. It is a fee on all goods imported into the country for home use. Into the country, basically for home use. So we know that the amount payable is about 3.5% of the goods that are imported. But the keyword is basically when you talk about import declaration fee, it is a fee that is paid on all goods imported into the country for home use. So we can pick the next question, that is B, a calculation question. That is on partnership. A calculation question on partnership, that is B. So the first thing we're being told that there is a Waka and Baraka started a partnership business in the year 2022, sharing profit and losses in the ratio of 5:3. So we have two partners, that is Waka, and we have Baraka, Waka and Baraka. So Waka and Baraka, the ratio is 5:3. Then this should be ratio of 8:5. Then this should be 3:8. That is the sharing ratio. That is basically the sharing ratio. So we're being told that the following is the statement of profit or loss for partnership in the year ended December 2023. So we're looking at sales. We know that sales, that should be a taxable income. General bad debts recovery, that is a non-taxable income. We have anticipated foreign exchange gain. When you talk about anticipated, those are not realized, so that's also non-taxable income. We have capital gain on the sale of land. Again, that is a non-taxable income. Then you have insurance recovery on stolen vehicle. When you talk about insurance recovery, basically on a stolen vehicle, that is also basically what we call a non-taxable. That is what we also basically called a non-taxable income. Then release of liability. When you talk about release of liability, then that is a taxable income. Release of a liability is a taxable income. Then you have interest from Ulinzi Sacco. When you talk about interest from Ulinzi Sacco, that is an investment income. So that is a non-taxable income in relation to the business. And we know that interest from SACCOs, we call them qualifying interest, where we're saying that the 15% withholding tax is final, and therefore we do not subject them to further taxation. Then we proceed to the expenses part. When you talk about the expenses part, we have the purchases. We have purchases, which is an allowable deduction, allowable expense or allowable deduction. Then you have purchase of computers. We call purchase of computers as non-allowable. Purchase of fixed assets are not expenses in taxation, so that is a non-allowable expense. We have repairs expenses. When you talk about repairs expenses, those should be allowable expenses. We have legal and professional fee. So on the legal and professional fee, we basically say that legal and professional fee can be allowable, and at the same time, it can be non-allowable. However, if an examiner brings a question on legal and professional fee and there's not an additional information, then that legal and professional fee should be allowable expense. The next is what we call rent and rates. Rent and rate, that should be allowable expense. Then interest expense, we say that interest on partner's capital, that is non-allowable. However, interest on loans borrowed, that should be allowable. So we can look at the additional information. General expense is allowable expense provided there's no additional information saying something contrary. Motor vehicle expenses, that should also be allowable expenses provided there's no additional information saying something contrary. Then we have the insurance, that should also be allowable expense provided there's no additional information relating to anything. Then we have what we call welfare expenses. Welfare, basically if you have welfare for employees, that should be allowable. Then we have audit and accounting fee. Audit and accounting fee, that should also be allowable expense. Then you have computer softwares and programs. That is a capital expenditure. So capital expenditure, those should be non-allowable expense. Then lastly, we have traveling expense, a figure of 64, that should be allowable expense. So if you look at the totals and we minus from the incomes, the accountant basically got a net loss of 2,750,000, and this needs to be adjusted as a tax person when now we talk about in terms of tax. So additional information, we have legal and professional fee. Total was 816. Out of that, there is a legal and professional fee, the first one, that is legal fee on defense against alleged breach of trade contract. When you have legal fee on defense against alleged breach of contract, those should be allowable. Those are allowable expenses. The next is legal fee on tax appeal. That is a non-allowable. So that needs to be added back. That is a non-allowable expense, which is in the P&L. We need to adjust it by adding it back. We have legal land conveyance fee. Land conveyance fee is also what we call non-allowable expense. So we need to add it back. Stamp duty is also non-allowable. Legal fee, we also need to add it back. Then negotiating a business loan. When we have legal costs that we incur to negotiate a business loan, that we also say that is also non-allowable legal cost. Then we have recovery of bad debts. Legal fee that relate to customers and debtors, that is allowable. That is an okay expense. Then we have signing 100 years lease agreement. When you talk about lease agreements, renewal and signing of leases, if leases are below 99, then those ones should be allowable. However, if leases are above 99 years, like the one we have in this particular question that says 100 years, then that should be a non-allowable. Then we have purchase of private or partner's private vehicle. That is a private expenditure. So purchase of a partner's private vehicle as a legal cost, that should be non-allowable expense. Then the last one of the legal fee, we have what we call legal fee on renewal of patent. Renewal of patents, that should also be non-allowable expense. So done on additional information 1. So additional information 2, we have repairs expenses comprised of the following. The first expense that relates to repair, we have the purchase of furniture. When you talk about the purchase of furniture, those should be non-allowable expense. When you talk about the purchase of furniture, those ones should also be non-allowable expense. We have what called designing and partitioning of a new block. Designing and partitioning of a new block, that's also a capital expenditure. So that is a non-allowable expense. Then lastly, we have what we call repainting of the old office block. That should be allowable. So that one we don't adjust by adding back. So we move to the to additional information number 3. Additional information 3. So we are told that impairment, 1 is impairment of patent, general expense. Impairment of patent, that should be non-allowable expense. The impairment of patents, that should be non-allowable expense. Then you have provision for general bad debts. Provision for general bad debts, that's a non-allowable expense too. We add it back. Then we have drawing of goods by partners. Drawing of goods by partners, we know for sure that those are non-allowable expense. So additional information number 4, that gives us to our working 1. We can call it working 1. So on the working 1, we're being told that purchases and sales were inclusive of VAT at the rate of 16%. Taxes paid or taxes refunded. Taxes paid are not expenses. That one we need to understand. The taxes paid are not basically are not basically expenses. So tax paid are not expenses. Again, we need to understand that tax refunds or tax that are basically on incomes, those are non-allowable. And we need to adjust the taxes on sales by lessing the taxes on expenses by adding back. So we say that purchase and sales were inclusive of VAT at the rate of 16%. So we have the first one, that is purchase. Purchase, the figure for the purchase is 3,706,000 was inclusive of VAT. So that implies that this was 116%. So what is the VAT that we need to add back that were on purchases that understated the profit? Remember the VAT, we say VAT on purchases understates the profit. So correction is correction, add back. So we get that VAT. So say 16 over 116 times 3,706,000. 3,706,000. If you look at that, we have 16. We have 16 over 116 times 3,706,000. So we have the figure is 511,172. 511,172.4. We round it to all numbers. So with this one, we are going to add back. So then we have VAT on sales, just on that VAT on sales. So we have the figure for the sales. If you look at the figure for the sales in this particular question, the figure for the sales is 5780. That inclusive of sales, that should be 116%. So what is the VAT on sales? We know that the VAT on sales basically overstate. VAT on sales, we know that VAT on sales overstates the taxable income. The VAT on sales basically overstates the taxable income. So we need to understand that the correction is to deduct. The correction is basically to deduct. So if you say that 5,580,000 is equals to 116%. What about that VAT that we need to deduct? VAT, which is 16%. So that should be 16 over 116 times 5,780,000. 5,780,000. So we have this. So that is 16 over 116, then times 578. So that should be that VAT that we need to deduct. That is 797,241. 797,241. 797,241. 797,241. So then we get to the next additional information. Working to. We're being told the closing inventory was valued at 120. So 1.2, sorry, closing inventory value. So the closing inventory value is 1.2. The figure is 1.2. That is the closing inventory value. The figure is basically 1.2, while the opening inventory was valued at 10% of the net sales. At 10% of the net sales. So we can get the value of opening stock. The value of opening stock. So the value of the opening stock was valued by 10% of the net sales. Net sales basically means net of value added. So the sales we have, if you look at the sales is 5,780,000. This is 116. So net of sales, that should be 100%. So net of VAT. So net of VAT, that should be 100 over 116 times 5780,000. So sales net of VAT, we have our calc, and we say that 100 over 116 times 5780. So what do we have? We have a figure that's 4,982,000, 982,000, 982,000, and then we have 982,000, then we have 759, 982,759, rounding it to all numbers. So with that we have the net sales. So the opening stock was basically, we were told that the opening stock is basically 10% of the net sales. So opening inventory, we have the opening inventory in that particular question, 10% of the net sales. That's 4,982,759. When you get 10%, there should be 498,275.9. So the opening inventory rounded off to all numbers should be 498,276 to 9. 498,276. That is basically the opening stock. So we're being told that opening stock and the closing stock were both undervalued. Opening stock and closing stock. We say undervalued at 10%. So we start with the opening stock. So this figure, 498,276, is undervalued by 10%, meaning it is 100 less 10. So this is 90%. So what is the undervalue, which is 10%? This is what you call the undervalue. So the undervalue that is 10% should be 10 over 90 times 498,276. For 498,276. So we get the undervalue, which is 10 over 90 times 498,276. So the figure is rounded to all number. That should be 55,364. So when you have 55,364, when an opening stock is basically undervalued, what is the correction? When an opening stock is basically undervalued. Let's have a practical example. We have SP sales. We just say sales 2,000. A practical example, sales 2,000. We have purchases 1,000. We have opening stock 400, and then we have the closing stock 500. So to get GP in this, particularly on this, to get GP, so we have this and this. So we have sales, that should be 2,000. Opening stock 400. Purchases 1,000. Then we have closing stock 500. So when that happens, we have 900. And so we know that when you have 900 there, the gross profit in that case should be 1,100. So if the opening stock in this case is undervalued, let's say we undervalue by 100, 300. What is the implication? What is the effect of undervalue of 100? So that would be now 300 plus 1,000 minus 300 plus 1,000, that is 1,300, minus 500, that is 800 now here. So we have the gross profit rising. So when an opening stock is basically undervalued, the correction is to deduct. It overstates, deduct, since it overstates profit. Deduct since it overstates the profit. So basically the correction is to deduct since that basically overstates the profit. So the opening stock that is undervalued of 55,364, that should basically be deducted. Then closing stock, we can have the closing stock here. Closing stock at this point. So the closing stock is a figure of 1.2. A figure of 1.2. That was also undervalued by 10. So that's 90%. So the undervalue is 10%. So that should be 10 over 90 times 1.2 times 1.2. When you basically do that, so we have 10 over 90 times 1.2. So the figure should be 133,333. So 133, we have 333, two whole numbers. So when closing stock is undervalued, the effect is that it understates. So we add it back. So it understates the profit. So the correction is to add back. So the correction is basically to add back. So we read the last additional information. Interest include. So the interest, we have a figure of 160 in the paper. The figure is interest. When you talk about interest expense, 166. Interest expense include interest on partner's capital of 120, which was shared according to the ratio. So interest on partner's capital is a non-allowable expense. So we need to note on that additional information, number 6, that 120 is a non-allowable expense that needs to be added back. But you're saying that under what we're going to take under partner's allocation, income allocation schedule, we are going to share this interest on capital based on the ratios. So we can have this working as sharing of interest. Sharing of interest. Interest on partner's capital. Partner's capital. So that's as we call it, we're working through there. So we have worker. That should be, worker is 5 over 8 times 120. Then we have Baraka. Baraka should be 3 over 8 times 120. 3 over 8 times 120. So we get those figures. So 5 over 8 times 120. So that should be 75. And we are taking them to income allocation schedule. So the other one will be 3 over 8 times 120. So we have 45. That's okay. We have that as 45. So that marks the end of those additional information. So required. We are told that to compute the adjusted taxable profit of partnership for the year ended 31st December 2023. So that is the first Roman A, B Roman A. So say you worker and Baraka partnership. Worker and Baraka partnership. Taxable, what do you call adjusted taxable profit? What do you call adjusted taxable profit for 2023. And we need to understand, because we've been provided with accounting profit, we need to understand that we are going to use the net profit. So we'll say we have this shillings on this. Then we know that in this particular question, we have been provided with an accounting profit. So we use what we call the net profit method. So say accounting loss stroke profit provided. So based on what was done by accountant, it basically said that this business made a loss of 2,750,000. So then we say add back non-allowable expenses, in P and L, non-allowable expenses in P and L, non-allowable expenses in P and L, then taxable, we say taxable incomes not in P and L, and taxable income not in the P and L. So when you look at this, when you look at basically what you have, so we start with the P and L, that is on the expenses. So we have the non-taxable, non-allowable expense that we have for the first one in the P and L, less expenses. We have purchase. We have what we call purchase of computers. We have the purchase of computers. So that's a figure of 216 that needs to be added back. 216. Then we have the next on that P and L. We look at the repairs, no legal fee. Just on that computer softwares and programs. We have computer softwares and programs. So that should be 1.2. Computer softwares and basically programs, that is 1.2. So then we have the first additional information that we have on legal. So we say that legal fee on defense against alleged breach, that is allowable. Then legal fee on tax appeal. We have legal fee on tax appeal. Legal fee on tax appeal, that should be 64,800. Then we have land conveyancy fee, what we call the land conveyancy fee. So the land conveyancy fee, that is 72,400. We also had stamp duty. We also say that stamp duty, that should be 36,600. That is a stamp duty. We can have the last one. Negotiating a business loan. What they call negotiating on this. Negotiating a business loan. That's also non-allowable. Negotiating a business loan, that should be 25,400. That should be basically 25,400. So I hope this is able. This is very visible as we look at that. So because of some entries that we need to have there, and then we have that. This entry we can wrap that we need to add back. That is VAT on purchases. That is basically VAT on purchases. 511. We need, as we wrap it, we need to put it there. So we have VAT. Another item, VAT on purchases. On the purchases, that is 1,511,172. So we go on with where we had signing 100 years lease agreement. So say signing 100 years lease agreement. Signing 100 years, that is more than 99. That should be 128. So we have 128,400. So then we have the next, that is purchase of partners. That is a private purchase of partners. We call it partners private vehicle. Purchase of partners private vehicle. That is a private expenditure. That is 137,400. We have that. Then the last one, we know that legal fee on renewal of patent. Legal fee on renewal, what we call renewal of patents. Legal fee on renewal of patents. So the legal fee basically on renewal of patent. Legal fee on renewal of patent. On renewal of patent, we have a figure of 126. That's a figure of 126. We can clear what you have. We know that we have that figure at the back of our mind. 7. We need to understand that we have it as 797, 241, so that we don't go doing the working again. So then we proceed to additional information number 2. We knew that the purchase of furniture is also non-allowable. That should be 260. Purchase of furniture. Then you have designing and partitioning. What you call designing and partitioning. What you call partitioning of new office. Designing and partitioning of a new office. That's also capital expenditure. That should be 341. So that is also added back. And that is okay. So we move to the third. Impairment of patent rights. That's non-allowable. What do you call impairment? Impairment of patent. What do you call patent right? Impairment of the patent right. We have a figure of 120. That's also need to be added back. Impairment of patent right. Impairment of patent right. Then provision of general bad debt, also non-allowable. Provision of general, what you call general bad debt. That should be a figure of 208,000. We add that back too. Then we have the last one, drawing of goods by partners. We have drawing of goods, also non-allowable, goods by partners. Drawing of goods by partners. So that should be equivalent to 314. Having a figure of 314. Then purchases, we knew that we needed to add back VAT on purchase because that's understated the profit. On the sales, we are going to less. So we're still looking at what items that we need to add back. So we proceed to opening and closing stock that were understated. We know that what we need to add back is closing stock understated. So we say closing stock understated. We say understated. The closing stock that is understated, that should be 133,333. 133,333. Then we have the last one, that is interest on partners' capital. We call it interest. Interest on partners. We call it partners' capital. Interest on partners' capital. The figure is 120. Interest on partners' capital. The figure is basically 120. So these are the items that we need to add back. What is the total of those items that are needed to be added back? We have 216. We had it 216,000 plus 1.2 down there plus 64,800 plus 72,400 plus 36,600 plus 25,400. We have that. Then plus 511,172. 511,172 plus 128,400 plus 137,400 plus 126 plus 126 plus 260 plus 260 plus 341 plus 120,000 plus 208,000 plus 314,000 plus 133,33. Then lastly plus 120. So the figure is 4 million. The items that we need to add back, 014,505. That is 4,014,000 and 14,505. So we go to less. Less, we know that we less non-taxable, taxable operating incomes in P&L, comma, investment incomes in P&L, investment income basically in P&L, and what to call and allowable allowable expenses, not in the P&L, not in P&L, and allowable expenses not in P&L. So what are we lessing? Non-taxable operating incomes in P&L, investment income in P&L, and allowable expenses not in P&L. And when you talk about allowable expenses not in P&L, this is basically the investment allowance, because we do not have deposition in taxation. So we move to those items. We look at the incomes. So the first one is general bad debt recovery. So we have general bad debt recovery, general bad debt recovery, general bad debt recovery. So that should be 75, the item that we need to less. Then we have anticipated, what we call anticipated foreign exchange gain. Anticipated foreign exchange gain, 180. Anticipated foreign exchange gain. Anticipated foreign exchange gain. So we look at that as we rotate that camera to that very hand, because of we have that. So then on those incomes, we also have capital gain on sale of land. What do you call capital gain on sale of land? Capital gain basically on the sale of land. That should be 352,000. Capital gain on the sale of land. That is a figure of 352,000. Then insurance recovery. Recovery on stolen vehicle. This is recovery on fixed assets, so that's also non-taxable. That is 320. An item that we also need to less. We have release of liability is taxable. We have now interest on from Ulinzi, what we call Ulinzi Sacco. Interest from Ulinzi Sacco. So Ulinzi Sacco, we know that that's a figure of 34, and that is qualifying interest. So we don't subject it. We do not take it to the income allocation schedule. So then we move on those incomes. We are sorted, but we know that VAT on sales, that was basically overstating profit. VAT on sales, we had 797,241. We noted it up there. Then we have the next item, that is opening stock understated. What do you call opening stock understated? So the opening stock that was basically understated, that is 55,364. Then we wrap this and move to the investment allowance. Opening stock understated. So as we wrap that, we now move to allowable expenses that are not in the P&L. So that is basically investment allowance. And this is, to be precise, wear and tear. So we can have the first one. We know that we have computers, We have computers. Those should be under investment allowance at the rate of 25. So that times 25% times 216. The investment allowance on that, 25% times 216. 25% times 216. 25% times 216 times 216. So that should be 54. Then we have the next. On the next was computer softwares. We have computer software. That's also 25% at the rate of 25%. That is 1.2. 1.2. That should be 300,000. That should be 300,000. 1.2. That should be 300,000. And then we have what we call, We have furnitures. Furnitures, we know 10%. Furnitures, we know that should be 10%. So furniture, we had on the furniture that was 260. If you look at that furniture, furniture was 260. So that is 10%. Furniture times 260 times 260,000. That should be 26. The investment allowance. Then we have partitioning. Partitioning. The partitioning figure was 341. We know that partitioning is also 10%. So times 10%, that should be 34, what do you call 34, 100. So these are the items that we need to less. So we can get the summation of items that we need to less so that we get the adjusted taxable profit or a loss. So I have 75 plus 180 plus 180, then plus 352 plus 320 plus 34 plus 797, 241 plus 55, 364, then plus 54 plus 300,000 plus 26 plus 34, 100. So this gives us what we have as 2 million. So we have 2,227,705 as items that we need to less. So we have the adjusted, what we call the adjusted, but A adjusted taxable profit or loss for the business. Adjusted taxable profit or loss for the business. So we have a loss, a negative of a negative 2, a loss which is that is a negative. So that is negative 2,750,000 plus 4,014,505. So when you had that, then we less, again we less 2,227,705. So what do you have? Adjusted taxable loss of 963,200. That is adjusted taxable loss of 963,200. So when you adjust it, they got it, accountant got it at this, but as we adjust it, we know that the loss was basically 963,200 using the principles of tax. Adjusting that, we have a figure of 963,200. So then we can proceed to the next part. We can proceed to the next part. The next part we've been told, allocation of profit or loss. So that is B. We can have that B here. What they call allocation of profit or loss. We stretch as we rotate the camera. We stretch as we rotate to have it on a clean slate. That is basically on this other end, to have it on a clean slate. We have it on the clean slate, but we can just have it on that end. We can just have it on this end. We know that this can be enough. So we have worker, we have baraka, we have baraka, and then we have totals here, and then we have totals on that end. So what do we start with? We start with items that we need to add: interest on capital. So interest on capital, there was a 120 that we were able to divide. The 120 that we were able to divide, as we rotate that camera, we can look at where we did the division or working. That interest on capital was basically 75 for worker, and baraka was 45. So we get back and have 75 on this. We have 45 on this. So then now we have a figure of 120. And then we have a figure of 120. Then we have a figure of 120. So then we proceed to the next. Is there salaries to partners? There's no salaries to partners. Is there interest on drawing? There's no interest on drawing. Is there bonuses to partners? We do not have that. So we have a column here. We call it the share of profit. We hold it. Share of profit. Share of profit. We hold it. Share of profits stock loss. Stock the loss. Share of profit stock the loss. We have taxable. 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 Operating. Operating profit. Profit or loss for business. Taxable operating profit or loss for the business that we got from our working. That is basically 963, 200. So we have that. So we look there keenly. So this one we call it A. We call this one B, sorry. This one we call B, and this one we call A. And sometimes for this particular question, we were simply basically having one item, that is the interest on capital. So how do you get the profit of share, which is C? C should be B minus A. So the taxable operating loss. So if you have a loss of 963, 200, and then you minus 120. You minus 120. So when you minus 120, we mean that there's a loss that needs to be shared. That loss is 1,083,200. How are they sharing it? As I do the working here, how are they sharing? I do the working here as the camera is being rotated. The ratio is still the same. Even that loss is supposed to be shared. So we have worker, and then we have baraka. Worker is having 5/8, and the total loss, as we rotate that, the total loss is 1083,200. So how much loss goes to worker? Then baraka is 3/8, 10,083,200. How much loss goes to that? So we get that. So times 5/8. So the loss that goes to worker, that should be 677. That should be 677. The loss that goes to baraka, that is 10,083,200 times 3/8. So the loss that goes there, that should be 406. This should be 406,200. So we have that loss that basically goes to this. So this should be 677, 677, 677. Then we have 406, 406,200. So what is the taxable operating income that goes to worker? We remember, under partnership, we do not tax partnership, but you tax basically individuals that are in partnership, So 75, which is a positive, minus a loss that is 677. So what do we have? We have a loss that is 602. That should be 602. That is, and that we also have a loss. The loss is bigger than the positive value. So if we take 45, so the loss basically decreased to 361, 200. So add, we just say add, other, taxable investment income. We do not have those investment income. There's none. So then we just wrap this again. We get the total taxable. We wrap that to get the total taxable income. Total taxable income. So we have worker, baraka, and then we have the total. The figure remains the same. So that is 602. That is a loss. That should be 361, 200, which is a loss. So the total loss we know is 963, 200. When that is added, 963, 200. So we cannot, in the first place, we cannot tax even these persons because they're making a law, they're making a loss. In the first place, we cannot tax partners. The partners, we say we do not tax partnership, but we tax individuals that are basically in partnership. That is how we basically tackle that question. That is question 4. But again, a point of essence, when you're doing these particular questions on calculation, remember it's the entries that count. So a student needs to be very careful and make majorities of entry. I always say that if you can make 75 to around 100% of the entries, you stand a better chance of doing very well in this calculation. And also just to encourage that these calculations are doable and that the perfect way is that students can basically score marks. That is how we basically sort that question 4, and that marks the end of the session that we have. See you in the next session.